All right. Looks like I got my head on straight. Can you guys hear me over on YouTube? Can you hear me? Can you hear me? You're the only one for me. Yeah. Could ever be. Yeah. My heart loves you, but my something won't try. Thank you. Thank you very much. All right. Wow. Holy bombshells, Batman. Ed's posting pictures in the lounge. M. Toshi is posting head and shoulders. Ed posted here a few minutes ago. Probably not a bad idea to throw this on the screen. Interest rate 3.9, previous 3.4. Ooh, that's interesting. I guess that's for the first year, second year, third year. God, they're talking way too much again. I hate when they talk this much. Interest rates current 4.4. Interest rate projection longer. I'm not quite sure what the hell all that means. But anyway, there you go. Merry Christmas. Hope that helps. Thank you, Ed. You are a scholar and a gentleman. Look at this US dollar just going for it here, although I can't see it because it's blocked. Here, let's see if I can do that. All right, so this is, the hegemony of the world and all that kind of talk. We did actually hit bullish bought objectives before. Kind of megaphony, eh? You can see lower lows and lower highs, so we could be in for quite a shitstorm here over the next little while. Keeping an eye open for Mr. Fed to actually start speaking. I am running this by myself right now, so I might screw this up, but I'll try my best. This is the Fed page right now. They're still just playing their silly elevator music. So as soon as that kicks in, we'll hop on over and listen to Jerry. And I do see that YouTube is making my life a little bit challenging here. So, hey, there's a few people. Hello, Jeremy. Hello, Adam. Hello, Arbortia. Hello, Kevin. Hello, Brad. Hello, Adam. Hello, Preston. God, I used to actually go to school with a guy named Preston. What the hell was his name? His dad was the governor of the British Virgin Islands, and he actually got into a lot of trouble years later for corruption. Oh, what a surprise. Anyway, still waiting on the Fed here. I suppose just a quick 64,000 foot view. Looks like momentum here pointing up nicely for the US dollar, so I don't know whether I'd really want to get in front of that. Having said that, for us to think that we'll see more bull, we got to go and take this high out here, 108.071. You can see she's got a full head of steam behind her, so there you go. US dollar index on the lower time frame, 30 minutes, big move higher. Euro absolutely collapsing. Japanese yen coming off here. Looks like it's actually catching a bit of a bid though. Swiss franc getting thumped. Gold getting bitch slapped. Look at silver going down. Even the crude's coming off a bit here. I'll pull up the regular matrix when Jerry's speaking so we can watch these things in the like the real short term. I think I have that on no, not that page. Thought I had it loaded up here. Doesn't appear to be on these ones. Maybe I have it over on another page. Yeah, this one, eh? So we'll switch over to here when Jerry actually starts speaking, so we can watch this stuff gyrate around as it usually does. Still not hearing anything from these clowns. I don't know whether... Let's see, what's going on? Still got the elevator music working. So as soon as they do start saying something, we will tune in. But right now, I'll just put this on mute. course, I'll put myself on mute when we're done. Interesting this look. Now we're looking at what I usually show you guys here. Hey, Stingby. Bitcoin and Ethereum lined up against the US dollar index. Here is the US dollar index on that 4-hour chart. Looks like a bull flag, eh? Euro trying to base out. Looks like we had like the knee-jerk reaction, and now we'll probably find that these things rally back and the US dollar calms down a little bit. We'll see. Maybe not. Who knows? I certainly wouldn't take any trades through this. This is that was a very violent move, and now you got to let things settle down a little bit here. Swiss franc, British pound. So Europe looking like shit. Looks like British pound's going to press to new lows here. Japanese yen, probably catching a bit of a bid here as a safe haven, ironically enough, in case the U.S. economy really rolls over. All right, looks like Jerry's about to speak, so shut the fuck up, Brian, and let's see what he's got to say. Here he is. Here he is.
Good afternoon. My colleagues and I remain squarely focused on achieving our dual mandate goals of maximum employment and stable prices for the benefit of the American people. The economy is strong overall and has made significant progress toward our goals over the past 2 years. The labor market has cooled from its formerly overheated state and remains solid. Inflation has moved much closer to our 2% longer run goal. We're committed to maintaining our economy's strength by supporting maximum employment and returning inflation to our 2% goal. To that end, today, the Federal Open Market Committee decided to take another step in reducing the degree of policy restraint by lowering our policy interest rate by a 1/4 percentage point. We also decided to continue to reduce our securities holdings. I'll have more to say about monetary policy after briefly reviewing economic developments. Recent indicators suggest that economic activity has continued to expand at a solid pace. GDP rose at an annual rate of 2.8% in the third quarter, about the same pace as in the second quarter. Growth of consumer spending has remained resilient, and investment in equipment and intangibles has strengthened. In contrast, activity in the housing sector has been weak. Overall, improving supply conditions have supported the strong performance of the U.S. economy over the past year. In our summary of economic projections, committee participants generally expect GDP growth to remain solid, with a median projection of about 2% over the next few years. In the labor market, conditions remain solid. Payroll job gains have slowed from earlier in the year, averaging 173,000 per month over the past 3 months. The unemployment rate is higher than it was a year ago, but at 4.2% in November, it has remained low. Nominal wage growth has eased over the past year, and the jobs-to-workers gap has narrowed. Overall, a broad set of indicators suggests that conditions in the labor market are now less tight than in 2019. The labor market is not a source of significant inflationary pressures. The median projection for the unemployment rate in the SEP is 4.2% at the end of this year and 4.3% over the next few years. Inflation has eased significantly over the past 2 years, but remains somewhat elevated relative to our 2% longer run goal. Estimates based on the Consumer Price Index and other data indicate that total PCE prices rose 2.5% over the 12 months ending in November, and that, excluding the volatile food and energy categories, core PCE prices rose 2.8%. Longer-term inflation expectations appear to remain well anchored, as reflected in a broad range of surveys of households, businesses, and forecasters, as well as measures from financial markets. The median projection in the SEP for total PCE inflation is 2.4% this year and 2.5% next year, somewhat higher than projected in September. Thereafter, the median projection falls to our 2% objective. Our monetary policy actions are guided by our dual mandate to promote maximum employment and stable prices for the American people. We see the risks to achieving our employment and inflation goals as being roughly in balance, and we are attentive to the risks on both sides of our mandate. At today's meeting, the committee decided to lower the target range for the federal funds rate by a quarter percentage point to 4.25% to 4.5%. We've been moving policy toward a more neutral setting in order to maintain the strength of the economy and the labor market while enabling further progress on inflation. With today's action, we have lowered our policy rate by a full percentage point from its peak, and our policy stance is now significantly less restrictive. We can therefore be more cautious as we consider further adjustments to our policy rate. We know that reducing policy restraint too fast or too much could hinder progress on inflation. At the same time, reducing policy restraint too slowly or too little could unduly weaken economic activity and employment. In considering the extent and timing of additional adjustments to the target range for the federal funds rate, the committee will assess incoming data, the evolving outlook, and the balance of risks. We're not on any preset course. In our summary of economic projections, FOMC participants wrote down their individual assessments of an appropriate path for the federal funds rate, based on what each participant judges to be the most likely scenario going forward. The median participant projects that the appropriate level of the federal funds rate will be 3.9% at the end of next year and 3.4% at the end of 2026. These median projections are somewhat higher than in September, consistent with the firmer inflation projection. These projections, however, are not a committee plan or decision. As the economy evolves, monetary policy will adjust in order to best promote our maximum employment and price stability goals. If the economy remains strong and inflation does not continue to move sustainably toward 2%, we can dial back policy restraint more slowly. If the labor market were to weaken unexpectedly, or inflation were to fall more quickly than anticipated, we can ease policy more quickly. Policy is well positioned to deal with the risks and uncertainties that we face in pursuing both sides of our dual mandate. On a technical note, we lowered the offering rate on our overnight reverse repo facility to align it with the bottom of the target range for the federal funds rate, its typical configuration. Technical adjustments of this kind have no bearing on the stance of monetary policy. The Fed has been assigned two goals for monetary policy: maximum employment and stable prices. We remain committed to supporting maximum employment, bringing inflation sustainably to our 2% goal, and keeping longer-term inflation expectations well anchored. Our success in delivering on these goals matters to all Americans. We understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you, and I look forward to your questions.
Gina Smialik with the New York Times. Thank you for taking our questions.
No baby
I
reference there.
Talk a little bit about why officials think it's appropriate to cut rates at all in 2025 if inflation is expected to remain firm throughout the year. And what would you expect at this point the timing might look like? Would a January cut potentially be possible, or does a pause next month seem more likely?
Well, so let me start by saying why we cut today and then move to 2025. So I would say today was a closer call, but we decided it was the right call because we thought it was the best decision to foster achievement of both of our goals: maximum employment and price stability. We see the risks as two-sided: moving too slowly and needlessly undermine economic activity in the labor market, or move too quickly and needlessly undermine our progress on inflation. So we're trying to steer between those two risks. And on balance, we decided to go ahead with a further cut, and I'll give you some details on why. Downside risks to the labor market do appear to have diminished, but the labor market is now looser than pre-pandemic, and it's clearly still cooling further, so far in a gradual and orderly way. We don't think we need further cooling in the labor market to get inflation down to 2%. Job creation is now well below the level, or certainly below the level that would hold unemployment constant. The job finding rate is low and declining, and other measures such as surveys of workers and businesses, quits, things like that, broadly show a much cooler labor market than we had in 2019. It's still quite gradually cooling. So we keep an eye on that. Inflation, we see that story as still broadly on track, and I'll tell you why. We've made a great deal of progress. 12-month core inflation, as I mentioned, through November is estimated at 2.8%, down from a high of 5.6%. But 12-month inflation has actually been moving sideways as we are lapping the very low readings of late last year. Housing services inflation actually is steadily coming down now, albeit at a slower pace than we might like, but it has now come down substantially, and it is making progress slower than hoped. And we've had recent high readings from non-market services and some bumpiness for goods. So I'll just say, so remember that we coupled this decision today with the extent and timing language in the post-meeting statement that signals that we are at or near a point at which it will be appropriate to slow the pace of further adjustments. You ask about 2025. I think that the slower pace of cuts for next year really reflects
his war with Trump,
both the higher inflation readings we've had this year and the expectation that inflation will be higher. You saw in the SEP that risks and uncertainty around inflation we see as higher. Nonetheless, we see ourselves as still on track to continue to cut. I think the actual cuts that we make next year will not be because of anything we wrote down today. We're going to react to data. That's just the general sense of what the committee thinks is likely to be appropriate.
Sorry, just one quick follow-up. Why, I guess, would you make those cuts? Like, what would be the trigger to cut?
So we're to cut further after this point. I would say it this way: we've reduced our policy rate now by 100 basis points. We're significantly closer to neutral. At 4.3% and change, we believe policy is still meaningfully restrictive. But as for additional cuts, we're going to be looking for further progress on inflation, as well as continued strength in the labor market. And as long as the economy and the labor market are solid, we can be cautious about as we consider further cuts. And all of that is reflected, to your question, in the December SEP, which shows a median forecast of down 2 cuts next year compared to 4 in September.
Howard Schneider with Reuters, and thanks for the opportunity to ask you a question. So this does seem similar to the dynamic in 2016 during the last transition to a Trump administration, where the committee saw slightly tighter policy in
first
part
injection of Trump.
in expected
Here we
anticipation
go.
of the fiscal policy stance that was seen evolving over the year. Some of it was a data mark-to-market exercise, and some of it was anticipation of fiscal. What's the split on this one? How much of this was accounting for inflation data that was coming in, and how much of it is expecting that there will be inflationary fiscal policy next year?
I'd say I'd point to 5 or 6 things, and let me start by saying that we think the economy is in a really good place, and we think policy is in a really good place. Let's remember that the economy is growing 2.5% this year, that inflation has come down by 50%.
Inflation's also 2.5%, which means growth is 0.
2.6%. Headline inflation is 2.5% on a 12-month basis. We're actually in a really good starting place here. But since, so what's really driving the slower rate cut path? First thing is growth is stronger, right? The economy grew faster in the second half of 2024 so far than we had expected, and is expected to be above what our expectations in September next year as well.
Down.
Unemployment is lower, and in the SEP you'll see that participants think that the downside risks are less and uncertainty is less. So that's more strength, right? Inflation is higher, as we talked about. Inflation's higher this year. It's also higher in the forecast next year. I'd also point out that we're closer to the neutral rate, which is another reason to be cautious about further moves. But then getting to your point, there's also there's uncertainty. Uncertainty around inflation, I pointed out, is actually higher. It's also in the case of some people, the way I would say it is this. Some people did take a very preliminary step and start to incorporate highly conditional estimates of economic effects of policies into their forecasts at this meeting and said so in the meeting. Some people said they didn't do so, and some people didn't say whether they did or not. So we have people making a bunch of different approaches to that. But some did identify policy uncertainty as one of the reasons for their writing down more uncertainty around inflation. The point about uncertainty is it's kind of common sense thinking that when the path is uncertain, you go a little bit slower. It's not unlike driving on a foggy night or walking into a dark room full of furniture. You just slow down, and so that may have affected some of the people. But as I said, there's a range of approaches on the committee.
If I could follow up on that, you mentioned the risk and uncertainty indexes toward the back of the document. The upside risk to inflation jumped quite substantially. The only thing really that's happened, you mentioned that the disinflationary story remains intact, yet the risk weighting has jumped to the upside. The only real thing that's happened is November 5th in the meantime. Is it fair to say that that's what's driving the higher sense of upside risk on inflation?
Actually, that's not the only thing that's happened.
I didn't think he was going to get caught there.
Our forecasts for inflation for this year, I think, are 0.5 higher than they were in September. So you had 2 months of higher inflation in September and October. As I mentioned, November is back on track, but once again, we've had a year-end projection for inflation, and it's kind of fallen apart as we've approached the end of the year. So that is certainly a large factor in people's thinking. I can tell you that might be the single biggest factor is inflation has once again underperformed relative to expectations. It's still going to be between 2.5 and 3. It's way below where it was, but we really want to see progress on inflation. As I mentioned, as we think about further cuts, we're going to be looking for progress on inflation. We have been moving sideways on 12-month inflation as the 12-month window moves. That's in part because inflation was very, very low measured in the fourth quarter of 2023. Nonetheless, as we go forward, we're going to want to be seeing further progress on bringing inflation down and keeping a solid labor market.
Chris.
Thank you, Chris Rugaber at Associated Press. Thanks for taking the question. In September 2018, the Fed staff in the Teal Book discussed a policy of looking through any new tariffs as long as there were one-time increases and inflation expectations remained anchored. Could you comment on if that analysis remains effective and any other thinking on tariffs generally that you can share?
So I do think that the September 2018 Teal Book alternative simulations are a good place to start. I happen to have brought them here with me today. I'm sure you have them too. They're a good starting point, and I would just say, it's 6 years old analysis, but nonetheless, this is still, I think, the right questions to ask. And there were two simulations. One was seeing through, one was not. And I'd point you. There's some language in the see-through paragraph that says, that considers situations in which it might be appropriate to see through inflation, and then names some conditions that in which it might not be. In any case, this is not a question that's in front of us right now. We won't face that question. We don't know when we'll face that question. What the committee's doing now is discussing pathways and understanding, again, the ways in which tariff-driven inflation can affect, tariffs can affect inflation in the economy, and how to think about that. So we've done a good bit of work, all of us have, each of us has, and it puts us in position when we finally do see what the actual policies are to make a more careful, thoughtful assessment of what might be the appropriate policy response.
Great. And just a quick follow-up. Given the recent bout of inflation that we've been through, with consumers seeing how prices can rise and businesses seeing that they can raise prices at least for some time, does that make it a little bit riskier to look through tariffs? I mean, do you feel you have to respond more quickly to inflation threats, given what we've seen in the past few years?
So the main thing is, and this is also a point in these alternative simulations, is there are just many, many factors that go into how much tariffs will even go into consumer inflation. How persistent will that be? And, so we just don't know really very much at all about the actual policies, so it's very premature to try to make any kind of conclusion. We don't know what will be tariffed from what countries, for how long, in what size. We don't know whether there'll be, retaliatory tariffs. We don't know what the transmission of any of that will be into consumer prices. To your point as well, I wouldn't say that we know whether the last episode is or is not a good model for what happened. You pointed out we've just been through a period of high inflation. We've just gotten through that period. That's a difference. There was also quite a bit of diversion of trade away from China to other countries since that. That may have effects. I don't know. I just think we need to take our time, not rush, and make a very careful assessment, but only when we've actually seen what the policies are and how they're implemented. And we're just not at that stage. We're at the stage of doing what other forecasters are doing, which is kind of thinking about these questions, but not trying to get to definitive answers for some time.
Nick.
Nick Timmeros of the Wall Street Journal. Chair Powell, to make sure I understand, participants
Ooh, he
today
does want
revised
his
up their
baby.
core PCE inflation projection for 25 so that the central tendency runs from 2.5% to 2.7%. And as Howard noted earlier, most of the committee sees the risks to those projections to the upside. So if inflation only declines next year from 2.8 to 2.5 to 2.7, what would compel the committee to be cutting in that situation?
Let me find these
Softer
numbers.
labor market. Duh.
So we have
Look at that Chinese
inflation coming
currency
down- Core
collapse.
inflation coming down to
Fuck me.
2.5 next year. That'd be significant progress. You see a slower path. I think that does take on board that we want to see real progress, but we'd be seeing meaningful progress to get inflation down to that level. That wouldn't be all the way to 2%, but that would be better than this year. This year will be 2.8 or 2.9. That would be meaningful. We also have to think about the labor market, and while we have the labor market forecast as being in good shape, we are also mindful that it is still out there very gradually cooling, so far in an orderly, gradual way. But it's also something we need to keep our eye on.
Oh, there's your
I guess if I
labor
could
market
follow up,
reference.
If somebody looked at these projections and also the insertion of the extent and timing language in the statement, which has been used at times in the past when the committee thinks maybe it's going to be on hold for a while, and they said, gee, this looks like it could be the last rate cut for some time, would they be mistaken to infer that?
So that's not any decision that we made at all. Let me explain extent and timing. So the sense of that wording is to make clear that if the economy does evolve about as anticipated, we're at a point at which it would be appropriate to slow the pace of rate cuts. So extent, that just relates to how much further we can reduce our policy rate consistent with getting to a neutral stance. Clearly, that distance has shrunk by 100 basis points. So it's significantly smaller. So that's the extent question. And we're going to be looking for further progress on inflation as well as a strong labor market to make those cuts. Timing just suggests, again, that we're at a place where we assuming the economy develops as expected, we're at or near a level that will make it appropriate to slow the pace of adjustment. So that's what we mean by that. We're not trying to make decisions about the longer run. We're trying to make sensible policy as we go. And I just would emphasize the uncertainty, which is it's just a function of the fact that we expect significant policy changes. There's nothing really unusual about that. I think we need to see what they are and see what the effects they will have. We'll have a much clearer picture, I think, when that happens.
Mike.
Michael McKee from Bloomberg Radio and Television. Even though you've cut rates by 100 basis points this year, we haven't seen much change in mortgages, auto loan rates, or credit card rates. You say you're significantly restrictive. Are you running a risk that the markets are fighting against you and the economy could be more at risk of a slowdown than you anticipate?
So the rates that you talked about are really longer run rates, and they are affected to some extent by Fed policy, but they're also affected by many other things. And longer rates have actually gone up quite a bit since September, as you well know, and those are the things that drive, for example, mortgage rates more than short-term rates do. So we look at that, but we look at all financial conditions, and then we look at what's happening in the economy. So what we see happening in the economy, again, is most forecasters have been calling for a slowdown in growth for a very long time, and it keeps not happening. So we're now well into another year of growth that looks like it might be 2.5%. Second and third quarters were right about at the same level. So the U.S. economy is just performing very, very well, substantially better than our global peer group. And there's no reason to think
U.S.
that a
economy
downturn
dominating
is
the
any
world
more
right
likely
now.
than it usually is. So the outlook is pretty bright for our economy. We have to
And the Beamish
stay on
called
task,
that
though,
shit.
and continue to have restrictive policies so that we can get inflation down to 2%. We're also going to be looking out for the labor market. We want to keep the labor market pretty close to where it is. We're pretty close to estimates of the natural rate of unemployment. Job creation is a little below the level that would keep it there, but nonetheless close. And so that's what our policy is trying to achieve.
If I could follow up by asking about your formulation for beginning rate cuts included the phrase, we need to have confidence that inflation is moving down towards our target. Given the fact that you've raised your forecast for next year, do you have confidence or are you uncertain about the path of inflation going forward?
So confidence was our test for raising rates. And, we made, look at the broader sweep. We've made just a great deal of progress. We're well into the twos in core inflation, and around 2.5 or even lower than that we have been for headline inflation. So I would say I'm confident that inflation has come down a great deal, and I'm confident in the story about why it's come down and why that portends well. And I'll tell you why. Again, you do see with housing services inflation, which is one that we've really worried about, it really has come down now quite steadily at a slower pace than we thought 2 years ago, but it's nonetheless steadily coming down as market rents start to equilibrate better with new leases that turn over, not new tenants, but new leases. Market rents is new leases. So that's happening. That process is ongoing pretty much as we expect. Goods inflation, which is another big piece of it, has returned right to the range where it was before the pandemic. Just for some months this year, it kind of moved up in a bumpy way because of used cars and things like that. But we think overall that should generally be in the range it was in. That leaves non-housing services, and market-based non-housing services are in good shape. It's non-market services, and those are services that are imputed rather than measured directly, and they don't. We think they don't really tell us much about the about tightness in the economy. They don't really reflect that. A good example is financial services, which is really done off of asset prices. And that's how that inflation works. So the overall picture, the story of why inflation should be coming down, is still intact. In particular, the labor market. Look at the labor market. It is cooler by so many measures now, modestly cooler than it was in 2019, a year when inflation was well under 2%. So it's not a source of inflationary pressures. Not to say there aren't regional and particular professions where labor is tight, but overall, you're not getting inflationary impulses of any significance from the labor market. So what's the story? The story is still just we're unwinding from these large shocks that the economy got in 2021 and 22 in, for example, housing services, and now also in insurance in particular.
Are you going to mention the hyper money printing,
those
sir?
are now being reflected later in housing insurance. It's real inflation, but it doesn't portend persistently high inflation. So we and most other forecasters still feel that we're on track to get down to 2%. It might take another year or two from here, but I'm confident that that's the path we're on, and our policy will do everything it can to assure that that is the case.
Colby.
Thank you. Colby Smith with the Financial Times. So the unemployment rate as of November, while
No
still very
baby
low,
reference
is within
there.
spitting distance of the level that generated a lot of concern about the labor market over the summer in the lead up to the 50 basis point cut in September. Hiring has also narrowed to just a handful of sectors. But now the committee appears comfortable skipping cuts at upcoming meetings. So what has changed about the committee's assessment of the risks confronting the labor market? Is there just less concern now on that front, or is it just about there being more upside risk to inflation that now needs to be accounted for?
The unemployment rate is now the same as it was in July, 4.2%. It's moved up and down, but it's now the same as July. And job creation is lower than it has been, but it's been steady. It's not declining. It's steady at a level which, as I pointed out a couple of times, is actually below the level that would hold the unemployment rate constant, but it's not so far below. So you might, if we have the break-even level right, and if job creation continues at that level in the establishment survey, then you would get a tenth maybe every other month kind of thing. So gradually declining. We don't have that kind of precision in this. So you're right, though, and I read out some of the reasons. We do think the labor market is still cooling by many measures, and we're watching that closely. It's not cooling in a quick or in a way that really raises concerns. I think you pointed out participants in the Fomc really thought that the risks and uncertainty had improved relative to the labor market, and it's because things have just gotten a little bit better. It doesn't, the unemployment rate flat and things like that. Nonetheless, we're watching it closely.
If the idea, though, is that no additional kind of softening in the labor market is welcome here, what's to prevent that from happening if rates are still restrictive?
So what I said is we don't think we need further softening to get to 2% inflation. That's what I'm saying. Not that it's not welcome. We don't need it, we don't think. If you had a situation where inflation's moving around by a tenth every few months, that's, we'd have to weigh that against the fact that inflation has in recent months been moving sideways in the 12-month window. And so we've got to weigh them both. And at this point, for a while there, we were only really focused, mainly focused on inflation. We've now gotten to a place where the risks of the two are, we think, are broadly, roughly in balance. And so that's how we think about it.
Steve.
Mr. Chairman, I did not hear you use the word recalibration today. And I'm just wondering if the recalibration phase is over.
Mr. Chairman.
And what you might call this new phase, and whether the criteria for changing rates is somehow
This is probably the only guy you should
before.
listen
Thanks.
to in the entire press corps.
We're not renaming the phase yet, but we may get around to that. But no, I would say we are, though, in a new phase in the process, as I said. So, and that's just because we've reduced our policy rate by 100 basis points. We're significantly closer to neutral. We still think where we are is meaningfully restrictive. And I think from this point forward, it's appropriate to move cautiously and look for progress on inflation. We've done a lot to support economic activity by cutting 100 basis points, and that's a good thing. I support the decision, and I think it was the right decision to make. I think from now, we are in a place where the risks really are in balance, and we need to see progress on inflation, and that's how we're thinking about it. So it is kind of a new thing. We moved pretty quickly to get to here, and I think going forward, obviously, we're going to be moving slower, which is consistent with the SEP.
I wonder if I could follow up and ask you how much you or the committee are looking through some of the high numbers we've had in the recent inflation numbers. For example, cars being up maybe because of the hurricanes, eggs because of the avian flu, that kind of stuff, and then looking forward perhaps to housing inflation coming down as it did in the recent report.
So we always try to be careful about not throwing out the numbers we don't like. It's just an occupational hazard is to look, those high months are wrong. What about the low months? We have a very low month potentially in November. It's estimated by many to be in the mid-teens for core PCE. So that could be idiosyncratically low. We try to look at not just a couple or 3 months. We shouldn't have, our position shouldn't change based on 2 or 3 months of good or bad data.
Warren just
We have
puking
a
out
long
here.
string now of inflation coming down gradually over time. As I mentioned, 12-month headlines 2.5, 12-month core is 2.8. That's way better than we were. We still have some work to do, though, is how we're looking at it, and we need policy to remain restrictive to get that work done, we think.
Neil.
Ooh, they'll probably pick up on that. Policy
Chair.
must remain
Chair
restrictive.
Powell, Neil Irwin from Axios. Financial markets have been very buoyant really all year. Is the committee comfortable with where financial conditions are, or do you see a risk that looseness in financial conditions could undermine progress on your inflation target?
So we do look carefully at financial conditions, of course, that's part of what we do, but
Where's the
what we
British
really look
lady? She's
carefully
always
at
cool with
is
her questions.
the performance of our goal variables and how are we affecting the economy. So what we've seen over the course of, just take the last year, we've seen inflation, over the last couple of years, come down a lot. We've seen the labor market cool off quite a bit. That suggests that our policy is restrictive. We can also look more directly at the parts of the economy that are affected by that are interest sensitive, like particularly housing. Housing activity is very low, and that's partly significantly because of our policy. So we think our policy is working, it's transmitting, and it's having the effects on our goal variables that we would want. A lot of things move financial conditions around, as you know, and we don't really control those, but I'd say we see the effects we're hoping to see on the goal variables and the places where we'd expect to see it.
So if I may, speaking of assets that have been buoyant, do you see any value or benefit in the U.S. government building a reserve of Bitcoin?
So, we're not allowed to own Bitcoin. The Federal Reserve Act says what we can own, and we're not looking for a law change. That's the kind of thing for Congress to consider, but we are not looking for a law change at the Fed.
Andrew.
Dodge.
Hey,
Not
happy holidays,
Doge, but
Mr.
Dodge.
Chairman, thanks for taking our questions. I was wondering if you are satisfied with the way 2024 is ending, if you're confident that we've avoided the recession that forecasters were predicting as inevitable a couple years ago.
I think it's
Look
pretty
at
clear
that
we've
US
avoided a
dollar
recession. I
surge.
think growth this year has been solid. It really has. PDFP, private domestic final purchases, which we think is the best indicator of private demand, is looking to come in around 3% this year. This is a really good number. Again, the U.S. economy has just been remarkable, and it's in these international meetings that I attend, this has been the story, is that how well the U.S. is doing. And if you look around the world, there's just a lot of slow growth and continuous struggle with inflation. I feel very good about where the economy is and the performance of the economy, and we want to keep that going.
The other thing I just wanted to ask about was the you guys have noted that the unemployment rate is still low. However, employment rates have fallen rather quickly. The prime age employment rate has fell by about half a percent rather recently. The question, I guess, is do you think there's maybe more downside momentum in the labor market than the unemployment rate alone is signaling?
I don't think so, no. I think overall, if you look at it, prime age participation is still very high. What's going on in the labor market is that the hiring rate is low. So if you have a job, you're doing very well, and layoffs are very low, right? So people are not losing their jobs in large numbers, unusually large numbers. If you are looking for a job, though, the hiring rate is low, and that's a signal of lower demand. It has come down. So we look for signs like that, and that's clearly a sign of softening, further softening. I didn't mention it earlier, but I think you can see an ongoing gradual softening in the labor market. Again, not something we need to see to get 2% inflation, and that's part of the reason that explains why we moved ahead today with the action, with an additional cut. So, but you take a step back, the level of unemployment is very low. Again, participation is high. Wages are at a healthy and ever more sustainable level, wage growth. And so the labor market, this is a good labor market, and we want to keep it that way.
Thanks.
Amira.
Thank you. Amara Mokway from Bloomberg News. I just want to put a finer point on the labor market. Can you
Didn't
keep the
even
labor
say his
market
name.
this
No
way
baby
in
there.
the strong position that you have described without further cuts? In other words, do you still view the labor market as needing support to protect against a further cooling?
You know, we can't know that with any tremendous certainty. I will say that we think that our policy balances the risks. We think the risks are roughly in balance as between the two
Ethereum
mandates.
is free fall.
And we think the labor market is in solid shape. And when I say it's softening or cooling, it's a very gradual process. You know, job creations are meaningfully positive. Wages are, you know, if anything, still a bit above what would be sustainable if productivity were to revert to its longer run trend. If you take into account the high productivity readings we've had, then wages are already at a sustainable level relative to 2% inflation. So I don't want to overstate the downside in the labor market, because the downsides clearly appear to have diminished. Nonetheless, it's one of our mandate goals, and you know, we pay close attention to it, and it's worth noting that it is still gradually cooling, gradually and in an orderly way. And you know, that's how I would characterize it, and that's why we're paying careful attention.
Elizabeth.
Thanks so much, Chair Powell. Elizabeth Schulze from ABC News. As you've noted, the Fed is now forecasting higher inflation next year. High prices are still a burden for so many households right now. Why do you think it is that inflation is proving to be more stubborn than you'd expected?
You know, it breaks
Because we
down
printed
into
the shit
a
out of
long
the
answer
currency.
if you want, but it just
gonna
has
say
been
that,
a little bit more stubborn. I think if you go back 2 or 3 years, many people were saying that to get this far down, we would have had to have had a deep recession and, you know, high unemployment by now. Well, that has not been the case. So, you know, the path down has actually been much better than many predicted. We've managed to have the unemployment rate remain essentially at its longer run natural rate, while inflation has come down from, you know, core PCE inflation has come down from 5.6% to 2.8% on a 12-month basis. So that's a pretty good outcome. Why hasn't it come down? One reason is that just a technical issue around the way we calculate housing services, and that process has been slower than market rents are showing up more slowly in that measure than we might have thought 2 years ago. So that's part of it. I think there are other parts of the story, but you know,
I won't mention
what I
the
think
fact that
people
we
are
bailed out the
feeling right
banks,
now
blah, blah, blah.
is the effect of high prices, not high inflation. So we understand very well that prices went up by a great deal, and people really feel that, and it's prices of food and transportation and heating your home and things like that. So there's tremendous pain in that burst of inflation that was very global. This was everywhere in all the advanced economies at the same time. So now we have inflation itself is way down, but people are still feeling high prices, and that is really what people are feeling. The best we can do for them, and that's who we work for, is to get inflation back down to its target and keep it there, so that people are earning, you know, big real wage increases, so that their wages are going up, their compensation is going up faster than inflation year upon year upon year, and that's what will restore people's good feeling about the economy. That's what it will take, and that's what we're aiming for.
You will never see lower prices in your lifetime.
Challenge to the economy under the next administration?
I feel very good about where the economy is. Honestly, I'm very optimistic about the economy, and we're in a really good place. Our policy's in a really good place. I expect another good year next year.
Edward.
Thanks, Chair Powell, for doing the questions. Edward Lawrence from Fox Business. So you say that we're closer to the neutral rate. What % do you see and the committee believes, where is that neutral rate?
That's a fine head he's got there, right?
I'll say a couple things. First of all, when we write, the thing we write down in the summary of economic projections is the longer run neutral rate, which is the neutral rate at a time when supply and demand are in balance, the full economy is in balance, and no shocks are hitting the economy. That is not where we are right now. So when we're making monetary policy at the Fed, That's not the question we're asking. So you can't do a straight read between those longer run numbers that we write down and what we think the appropriate policy should be. So basically, at any given time, various shocks are hitting the economy. And so what we're doing in real time is we're looking at our policy stance and we're looking at the way it's hitting the economy. And particularly, we look at the effects it's having as we try to move the economy toward maximum employment and price stability. And the answer can be, there are things that affect the economy that are lasting but not permanent. And the ones that are permanent are the ones that would be in our star. The ones that could be lasting but nonetheless go away over time, they could actually affect what's sort of technically the appropriate neutral stance in near term. So we're looking at that, and we don't know exactly where it is, but as I like to say, we know it by its works. And I think what we know for sure is that we're 100 basis points closer to it right now. There are many estimates of where that might be, and we know we're a lot closer to it, and I think we're in a good place, but I think from here, it's a new phase, and we're going to be, cautious about further cuts.
But I think that the markets are looking for a little more clarity. I mean, I've heard estimates from 2.9% to 4%. I think the markets would like to see a little more clarity about a year out, 18 months out, as to where that goalpost, for lack of a better term, is, because at the moment it looks big.
Yeah, I mean, honestly, there are countless models of what a neutral rate might be at any given time. There are empirical models, there are theoretical models, there are things that combine them, and they have as many different answers as you'd like. So there is no real certainty. And I mean, it's actually a good thing to know that we don't know exactly where it is. So you're not tempted to think, oh, I think this model or this estimate is right. You just have to be open to the empirical data that are coming in and also how it's affecting the outlook. And it's not made any easier by the fact that that our policy works with long and variable lags. Nonetheless, that is the job we have, and so I think it's appropriate for us now to proceed cautiously, now that we're 100 basis points closer to neutral, and we'll do so. Meanwhile, the economy seems to be in good shape, and these cuts will certainly help to support economic activity and the labor market, while we can still make progress on inflation because policy is still meaningfully restrictive.
Victoria.
Hi, Victoria Guida with Politico. I just wanted to make sure I understood what you were saying at the beginning about inflation. Are you saying that progress on core PCE counts as progress on inflation, even if headline inflation ticks up? And then also, since that's what's projected in the SEP, I was wondering, what accounts for that? Why do you all see core PCE going down and potentially headline inflation ticking up?
So, and as I imagine the goal overall is headline inflation because that's what people experience. People don't experience core inflation, they experience inflation, and that includes food and energy costs. So that's the overall goal. But, as we know, headline inflation contains energy and food, and those prices can fluctuate for reasons that are not related to tightness in the economy and therefore are not really good predictors of future inflation. So it turns out that core inflation is a better predictor of overall inflation than overall inflation is. So we look at core inflation because it's a better measure of what future inflation is likely to be because it's a better measure of what inflation pressures exist. So it's complicated, but ultimately our goal is headline, not core. So your second question was what?
Why do you all see core going down but headline potentially ticking up?
So headline can be affected, you're talking about next year. Mm-hmm. Yeah, so headline can be affected by energy prices and food prices. So that there will be things in the headline forecast that are to do with forecasts of energy prices, whereas core will be, if you look at core going out a full year, then it'll be much more driven by things like tightness in the economy. So that's why the two can go in different directions. Headline has been lower, as you know, most of this year, but that's because energy prices have been coming down, which is a great thing for people, but energy prices will come down and then they will go up, and it won't really be telling us anything about how tight the economy is and how future inflation will perform.
Do geopolitical risks factor in at all to how you're thinking about energy
So
prices?
we monitor geopolitical risks really quickly, but, really carefully, rather. But,
well, there's a slip.
I would say so far those risks haven't really, nothing has come out of those risks that really has really been important for the United States economy. The single thing that you would look to is the price of oil, given that we're talking about the Middle East and Ukraine but that is a good summary statistic.
I won't
for
even
the kind of
mention
thing that
Russia.
could go wrong with global turmoil, but the price of oil's been coming down, and because of supply conditions, global supply conditions. So the U.S. is not feeling really the effects of geopolitical turmoil, but we are certainly at a time of elevated geopolitical turmoil, and it remains a risk.
Kelly.
Thanks, Chair Powell. Kelly O'Grady from CBS News. I want to go
Finally,
back to something
a
that
Chair
you
Powell.
said a minute ago, that wage growth is outpacing inflation now. It wasn't the case for some time, of course. It's partly why Americans haven't felt
she
much
looks like
relief
an
in their
economist,
wallets from
doesn't she?
prices yet. But with inflation ticking up, how worried are you the progress in closing that gap could go away?
Yeah, so inflation, again, we don't overreact to a couple of months of higher readings or a couple of months of lower readings. And what we had was we had 4 months of really nice readings, and then September and October were higher, but then November is much lower. So I don't really think the public is experiencing that as a surprising upside risk to inflation. I think inflation is much lower. What the public is feeling, and they're right about it, is that prices are just, the price level went up because of the past inflation, and it's going to take some time for real
Prices
wages
went
to
up
recover
because
over
of
a period
past
of years in
inflation?
which
Come
your
on.
real compensation is growing. And in other words, your compensation is growing meaningfully faster than inflation. That's exactly the kind of economy we have now, and we just want to hold on to it. That process will probably take some years, but that's what's going on right now. And I don't think that a couple of months
this is
of
enough to
higher
trigger
inflation
me.
really signal that anything of the nature you're suggesting.
And just one follow-up. Let's look more long-term. You previously predicted hitting the 2% inflation target in 2026. It's now been pushed out to 2027. You said you're focused on enabling further progress on inflation. That's not necessarily progress in the right direction. Are you confident that target isn't going to move further out?
We're talking about when you're projecting the economy, 3 years out, 2 years out, you're talking about high uncertainty. Very high uncertainty. We really, at that point, it's not possible to confidently predict where the economy is going to be in 3 years. So what we're doing is we're looking at what's happening now, and we're kind of projecting that the same kinds of things are happening. So we keep a strong labor market. Housing services inflation comes down. Goods inflation settles down, and non-market services return to their prior level. All of those things should happen over time, and those pieces come together. There's every reason to think that they will. The timing of it is highly uncertain. But you're not wrong, though, that it's been a bit frustrating because while we've made progress, it has been slower than we had hoped. Nonetheless, we're still on track, and I think if 2 years ago you'd said we were at 4.2% unemployment and 2.8% inflation, people would say, "I'll take that." I mean, that's a pretty good interim place to be. Job's not done, but I think we're feeling good about where we are and where we're headed.
Go to Nancy for the last question.
Hi, Chair Powell, Nancy Marshall-Genzer from Marketplace.
Ooh, we did get
You
another
said
Chair
a couple
Powell.
times inflation
Where's our
has
British
been moving
lady?
sideways. Appears to be settling in around, 2.5%. Do you think the Fed is just going to have to settle for that and accept?
Hate to
that
say
you're
it,
not
but
gonna
she
get
looks like an
to your
economist.
2% target?
No, we're not going to settle for that. I think we certainly have every intention and expectations that we'll get inflation back sustainably to 2%. That is, and I am confident we will achieve that. It has taken longer, but you have to be. We are making progress. We have made a great deal of progress, and we'll continue to do so. and get back to 2% inflation. That's what we owe the public, and we're committed to achieving it.
In that case, can you rule out a rate hike next year?
You don't rule things completely in or out in this world. That doesn't appear to be a likely outcome. I think we're at 4.3%. That's meaningfully restrictive, and I think it's a well-calibrated rate for us to continue to make progress on inflation while keeping a strong labor market. So, thank you very much.
Well, there you go, folks. Merry Fishmas. That was quite startling, eh? I guess we can put that away now. All right, a summary of what the hell we just saw. I'm going to put away the Fed picture here. Let's see if I can figure out how to do this. Whoops. Browser. Boosh. All right, that should disappear, hopefully. All right. Wow, I don't think anybody was expecting that monstrous rally out of the U.S. dollar there. I think that caught a lot of people off guard. Also, too, interesting, look at that. We took out horizontal support and resistance up top. So that, by definition, means we should be thinking something like A to B. And then C to D. We'll see. Obviously, these things never move in a straight line, but it'll be interesting to see if the U.S. dollar can work its way up there. I guess you also have this A, B, C, D, so maybe that level was just traded too. Let's see what we got there. A to B. And C to D. Oh, okay. Well, that was actually previously hit, so I think that's actually done. I will say, my experience in the market, very rarely do we see multiple A, B, C, Ds just keep working one after the other. So we'll see what happens here. Higher highs and higher lows defines a bull, though, eh? So I certainly wouldn't be calling a top into this. And interesting how they're going to end the year on a pretty strong note here. So maybe an idea for us to zoom out and take a look at some of the bigger time frames. Look at that, eh? So we were looking at our 3-minute chart. Oh, okay, that's not that big. Then we scroll out to the higher time frames and wow, holy destruction, Batman. Did hear somebody make reference to strapping on a silver trade here because of seasonality. And what I would have said there was with this huge FOMC event happening here and lots of uncertainty about direction of rates going forward, maybe it would be an idea to let that FOMC event happen before we go and make any big bets in the marketplace. They always say currencies lead everything, and the big boys du jour are euro and yen. So is capital flowing in or out of Europe? That looks pretty bad. Probably an A, B, C, D there. I don't know whether we've hit downside targets, but you notice we have a new, almost like an inverted, I guess the head and shoulders. A new M here. If anything, I think I saw Sjord poke his head up in the lounge there a minute ago. So hopefully this will be some good news for him. If he gets paid in US dollars, he's going to get a pay raise here. Well, we'll see how it goes. I think I showed you this on the Canadian dollar here recently as well. You can see just off of this range here alone. I don't know whether these are old studies or new ones. Oh, I guess this is a bearish bot. So A, B, C, D. That's suggesting euro needs to get down into the 87 level. Wow, that would put a smile on Sjord's face, I bet. I would say Fomc here. We probably can start painting some downside objectives off of that range. chaos. Oof, there we go. There's Julian's level. So Julian's going to be getting all excited on a test of this original bottom here. 2.618s, 4669s. Woo-wee, all the way down here at 76. Wow, that would put a smile on Stuart's face. And if you don't think that this can happen, well, just take a look at the old Chinese dollar. I mean, this is an absolute train wreck. And of course, I tell everybody repeatedly, stay the hell away from this nightmare of a country right now. It's an absolute disaster. But you can see A, B, C, D, and now, had you taken that bought short, you'd be being told, move your stop to scratch now. Shouldn't lose money on this. And look at that. I mean, Jesus. There's the definition of somebody going and buying that, trying to catch a falling knife. You have no idea where the hell this thing's going to bottom. And listening to Jerry there, everything that I heard out of Jerry was, you know what, we're probably at the point where we're not really going to be moving rates a lot. Neither up nor down. That's what I kind of heard out of him. So as a result, you raise interest rates if you think inflation's a problem, and you can clearly see the market is not even the slightest bit concerned with inflation from market-based proxies, and also too interesting, not even the slightest bit interested in crypto. This might even be a little bit of a tell that you see dominance actually start to perk up, and the whole sort of love affair that the market's had with the shitcoin market of late, it might actually come under serious fire here. Don't be shocked. A lot of these cryptos have moved up egregiously. At TRI, we were banging out doubles, triples, quadruples, quintuples. I mean, it was kind of ridiculous how big the numbers were. And you also heard, in fact, around the TRI lounge, which I thought was really interesting, heard a lot of people saying, I just got a call from Uncle Louie, who I haven't talked to in, probably about 3 or 4 years since the last time Bitcoin was going crazy. And now all of a sudden he's going and buying Bitcoins. And I actually heard somebody say that one of their family relatives literally went and paid $100,000 for a Bitcoin. It's like, you gotta be kidding me. Well, I suppose if it goes to 1 million, well, then it's worth it, right? But I don't know. Feels like you're chasing. And interesting, the reaction out of the stocks, eh? Woo-wee. Holy nosebleed central. I definitely heard from Jerry, and I also noticed interesting how he conveniently avoided talking about certain topics and certain directions of conversation. Definitely heard out of Jerry that a lot of these banksters are fully expecting inflation to tick up with all of these tariffs. I actually wouldn't be surprised if the tariffs offset by a collapsing oil price. I think oil is going to come off hard here over the next few years. I think it's going to basically make the inflation a zero-sum game. I don't think inflation's even going to be a problem here. The tragedy of this, and you even heard a few of those news broadcasters or media, whatever their name is, even say, the public's not feeling so good about the way that you've absolutely cranked prices up here, and when are prices going to go back down to earth? And you basically heard from the bastard go, they're not coming down. Get used to it. The only way you are going to be able to handle this new world is you've got to go out and demand pay increases. But aren't you trying to keep the labor market relatively tight here and under control? Yes, we are. But didn't you just say that the only way we're going to get happy is if we demand higher wages? Yes, I did. Well, what the fuck? So workers are not going to ever get happier again. Oh, we're not allowed to say anything along those lines. I mean, you even heard me when he was talking there. I was like, oh, fuck, this is going to trigger me. I'm going to lose it here. I mean, it's disgusting how corrupt all of this is. And you notice, this is the thing that really pisses me off about all of this, is you notice that not a single one of those damn news reporters, not Not a single one of those news reporters made even the slightest bit of reference to what is really going on here with inflation. And this is what just drives you crazy about this is, what was the point of that whole news conference? I mean, what was the point of it? If none of them are going to ask the actual pertinent questions that actually drive inflation. Milton Friedman, probably one of the only economists that we can actually quote with a half-decent head on his shoulders, outlined inflation is a monetary phenomena. And of course, by the time Volcker comes around and says, you know what, we better have a war on inflation. And what are we going to do? What is the very first thing he does? Takes interest rates to double digits and just brings the economy to a grinding halt. But nobody's going to talk about what inflation actually is. And you even heard him, oh, well, inflation's been ticking up lately. Well, of course, because you're fucking money printing again. I thought we'd stop this shit. What are you doing to us? And yet not a single one of those damn reporters even dares to mention what real inflation is. Because they know that if they start talking about this, they won't be invited back to the next FOMC press conference. It's stunning how corrupt all this shit is. Just stunning. So, I mean, the interesting thing here is on a relative basis, and this is probably why the US dollar is outperforming, as you can see, the United States of America, and especially with Mr. Trump coming along here, if Mr. Biden had won that election, or, Cammie and all that shit, holy fuck, the money printing would have just gone crazy. So the fact that Mr. Trump has come along here, and we'll see what happens, only time will tell, but I do think to a certain degree that the United States is the only region in the world here that's actually exercising some fiscal discipline. And are you seeing it in the currency behaviors? Do you all see? Can you see how this is so incredibly connected? These currencies are basically in free fall. I mean, everything's in free fall. The only thing that's moving up is the US dollar. Fascinating. What do you think? Is that a risk on or risk off vote? Like, I get the distinct impression that the election happened and everybody went, woohoo, all right, it's party time. And man, I mean, being around Trump's world, like Mar-a-Lago, like over the past few weeks, I bet you it's been a really, really good time. Major hangovers, hookers and blow everywhere. And I do believe that the market just got a big slap in the face. Go sleep it off. Let's get back to reality here. And I distinctly heard from Jerry, if you think that we're going to roll over and play dead for Mr. Trump, you got another thing coming. So it'll be interesting to see if there's any legs to this risk off vote here today. My feeling here is that I just think that the market just went a little bit too far, a little bit too fast. I've been talking, it's fascinating how the breadth indicator at TRI has been actually screaming problems for a while now. And the irony of it all is that, I got to figure out where I can show you this. Hold on a second. Where is, and actually my browser crashed about an hour or two ago because I have too many tabs open. So this is a bad habit of mine. Here we are over here. The breadth indicator here has been sort of saying, this is dangerous. Very. And interesting how everything is just getting all washed out here in the short term. So we're not technically, well, some of them are. We're getting oversold in the bonds in the short term. That's interesting because we watched the bonds really melt down there while Jerry was speaking. Short term looks like commodities also kind of getting wiped out. country funds. The world equity market is not a happy place right now. Go check out, you want a joke of a laugh, go check out what's happening in China right now. It's just embarrassing. It's just day after day after day, a train wreck. Ironically enough, the one part of the market that's actually relatively happy on the short term is crypto. We'll see at the end of the day, though. My hunch, especially with the way this market's been acting, you're going to see all of these things down on their knees. But here's the problem. The medium-term picture, we don't have anything oversold here yet. How bad does this picture in the short term have to get for the medium-term picture to start rolling over? That's how violent that rally was that we just saw coming out of that election. And I've actually talked to site members about this. I'm a bit concerned that they've built like a 2 or 3 year rally in the stock market in the matter of a month or two. So now what do we have to do? Do we have to grind lower for 6 months to get this medium term indicator to actually get washed out, oversold, so that we can start getting bullish again? And I hate to say it, but I think the answer is yes. Like our breadth indicator here, for us to be like, holy shit, this is a buy, we got to get in there. This teal line has to come down below 20 and start Wing out. How long is that going to have to take? Might take weeks. So I wouldn't be in a big hurry to call bottoms here anytime soon. We could probably go market by market by market. Jesus, selling's getting even worse. Probably, for this audience, we'll leave it here at Bitcoin. I think it's probably a perfectly, where the hell's Bitcoin over here, right? I think it's probably a perfectly good proxy here for you to understand the broader market. You can see everything's looking exactly the same. So, we'll finish off this broadcast with a quick boo at yield corn, and where should we be thinking about this thing going here in the near term? Was interesting in today's daily brief. We had even talked at length, and it was kind of funny. We even talked at length, although I don't know where I can find it, about the fact that Bitcoin actually hit a bot objective. So if you were a bot trader, you actually got filled here this morning. Yeah, interesting. So here is the bot trade. Look at this. I mean, is there ever a perfect reason why to learn how to trade setups? This is incredible. I even spent a lot of time in the daily brief here today talking to the TRI audience about this very setup. And the fact that, it was funny, my browser literally crashed the moment I finished that, trying to get this video loaded. Anyway, look at that low, 49,577. So let's just make sure this is correct. Yeah, let's zoom in here and make sure this number is spot on. So we said that number was 49,577. So we'll go down here, 49,584, 77. There we go. All right, so let's see where we were supposed to have our AOCO order working. And you literally get taken out of the market right into the absolute orgy panic buying. I always love that about the bot. It's so much fun. Bot trade. There we go. So look at that target hit. Oh my goodness. So, the rule is, right, you place your buy on stop at the 25 level. You move your stop to scratch at 50%. Start locking in profits at 66%, and 100% of the move, you should actually work open orders to sell at that level. And look how that level was traded to first thing this morning, and we don't. That's poetry if I've ever seen it. Absolutely beautiful. I still think that there are a couple upside objectives here that I think need to be traded to. Again, we review all this in our daily brief videos. At least I do. I do the daily brief video now Monday, Wednesdays, and Fridays. Actually, Friday, we're going to have a couple of our OGs on to talk to us about Arbitrum, and the fun he's having over there. So if you are a TRI OG, be sure to tune into that with Steven. It should be, and one other site member is going to be on the call. It should be a fun podcast. That's on Friday. As I said, I still think that there are a couple upside objectives. One 2.618, one 4.669, and I think really should be traded to. What I think ends up happening here, though, is remember the inauguration. I think that's the actual big psychological event, and that is there. So we're getting close, and if we start actually seeing serious trade location warnings, then ideally what I'd like to see here is I'd actually like to see momentum divergences develop on your indicators. So market, goes to new highs, and your indicators actually do not go to new highs. So I could see, well, maybe not like that, but you get the idea. Up like that. And you get that divergence message. That's probably what I'll be looking for here over the next few weeks from our momentum indicators. I still think that there are a couple upside objectives to go. And yeah, I mean, that's one hell of an ugly bar here today, but one bar itself is not an actual sell signal. I definitely think it was a take profits event window there for botters. But that's not a top unto itself. And frankly speaking, you see the size of these tails. They're going through the process right now of just freaking out all the noobs that have come into the market here. These kind of violent moves up and down are nothing more than to shake out the weak hands. For us to actually see that, yes, indeed, there is a top, right? We want to see things like M's, an actual market structure signal. And then we should probably be looking for some sort of correction. And then when the darn thing actually does go in W again, then we look for the bull to resume. So right now, if anything, if you traded Bitcoin here, and actually I think if I'm not mistaken, we actually had a pretty big technical trade level traded to. And one of our OGs, and he runs a site on his own. I don't know how his site's doing, but I hope it's doing well in this environment. But one of our OGs actually posted, in the lounge and all that kind of fun stuff. Hey, I just got paid majorly because I traded that setup. Way to go, Colin. You're a fucking boss. And I just like to surround myself around these good traders. So proud of Colin. And, he's like one of the only people I actually heard recently who is saying, I'm selling into this rally. I'm selling. I'm taking profits. I didn't hear very many people talking about taking profits. The way that I approach the market, I have no choice. I have to sell at very specific levels. So what ends up happening with a guy like me is, if we bang into a level, boom, out goes a whack of coins. I get a huge whack of cash handed to me right now. And ironically enough, our little old lady demo portfolio was funded with 10 Gs last year. I've got a ton of positions on the books, and I've got now like 12,000 in cash just sitting waiting for all of these markets to come back down to earth so I can go and buy them all back. That's the way that I approach the market. So anyway, I hope you enjoyed the broadcast here today. I don't really have any outright short signals anywhere in sight here. It's just this market's gone way too far, way too fast. And if anything, keep in mind, this is a weekly price chart. And, probably we'll call this the call-in broadcast, because I think I'm going to leave off with you with just a very simple message. Colin, his time at TRI, and he's worked like a dog. I think he has become a very, very good technician. And he actually took one of our basic concepts, and he even kind of like made it his own. Called it the pump chaser zone. This is 38.2. We should expect the market to retrace 38.2s at any given point in time. Good old Ray Burchett, Ray Barbecues levels. And there's the 50% level. All that is just a natural rubber band has been really stretched in one direction, and we're just going to bring it back to the midpoint and just relieve that overbought condition. So what this means is, and like I said, leave off with a shout out to Colin, damn good trader, and also a very good market sort of wisdom. We call this, and he calls this Colin's pump chaser zone. So yes, the market's pumping, but that doesn't give you permission to go and just FOMO buy. Maybe just cool your jets, wait for markets to come down to levels that they really should come down to, and then hunt your setups. And of course, anybody who's a student of mine knows that this has got bought written all over it. And we might just do some sort of consolidation like this and set up the next leg higher. But right now, we have to wait for the consolidation. And I think it's just that simple, folks. So anyway, hope you enjoyed that. Slow and steady wins the race. Don't take no win nickels. Remember what your number one job is. Trade setups. What are your 3 unrelated, and I think they should be technical reasons? I am seeing a lot of people inject, oh, well, you know what? Fundamentally, that guy said that, so I'm going to include that as one of my reasons. No. Location, indicator confirmation, price structure, go. Those are the 3 reasons I want you thinking about. So in this particular scenario, if it plays out the way I think it is, our trade location will come in on the pump chaser zone. Then we'll look for indicator confirmation, seeing that we've got bullish structure in our indicators, and then we'll hunt price structure. And ideally, of course, we'd love that to set up at bot levels, and away you go. All right. I think I'm going to leave the rant at that. Sure hope you guys enjoyed. What's this? Hey, Brian, told you here about a flu in California. Well, I heard the chickens are dropping like flies, eh? I suppose that was one of Jerry's comments there. Anyway. All right, let's leave it at that. Have yourselves a great day. Enjoy Julian's offering tomorrow. And we'll see everybody on the site on Friday for a really interesting conversation that we're going to have with Stephen. And I think the Matador, if I'm not mistaken, if that's your real name, Bart Simpson. If you have any questions, feel free to reach out. More than happy to try and help you. All the best, and bye for now.